Right now, we are in one of the most important 48 hours in global finance. Stop what you're doing and pay attention. What happens in Tokyo on February 9th could decide if your money grows or disappears over the next 6 months. The entire financial world is on a razor's edge. Stocks, bonds, real estate, crypto, all of it. And the pivot point, the Bank of Japan. Hello everyone, welcome to John AG Expert. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe. And now let's get back to the market update. On February 9th, the BOJ will make a huge decision. Either keep printing money or raise interest rates. That one decision will trigger a chain reaction that could shake the global economy to its core. This isn't fear-mongering. This is math. Japan isn't just another country. It's the keystone of the global financial system. For 40 years, easy money from Japan has helped shape the world economy. If Japan stumbles, everything built on that foundation could collapse. Here's why Japan has this power. Since 1990, after its asset bubble burst, Japan has been stuck in deflation, prices falling, wages stagnant, and growth missing. For 30 years, the Bank of Japan has tried everything to fix it. Interest rates at zero, then negative, printing trillions of yen, buying government bonds, corporate bonds, stocks, you name it. The BOJ basically became a giant hedge fund trying to kickstart inflation. And for 3 decades, it didn't work. Deflation persisted. Growth didn't come. Japan stayed stuck. But now, things are changing. In the last 18 months, inflation has arrived, not from domestic growth, but from global shocks, energy crises, supply chain problems, rising commodity prices, and a weaker yen making imports expensive. Suddenly, Japan is seeing 3 to 4% inflation, the highest in 40 years. People who lived through decades of stable prices are panicking. Their wages aren't keeping up. Their savings are losing value. Their standard of living is dropping. They're demanding action. And this puts the BOJ in a nearly impossible spot. Keep printing money and keep rates at zero. Inflation spikes. The yen falls. Prices go up. Political pressure mounts. Raise rates. Risk crashing the stock market, bankrupting the government, and triggering the very deflation they've been fighting for 30 years. Japan's financial system is built on the idea of zero interest rates. Change that, and the math falls apart. The debt becomes unmanageable, and the whole system is at risk. Let's break down the numbers because they explain why the world is watching Japan so closely. Japan's government debt is massive. 240% of its GDP. That's $10 trillion of debt on a $4 trillion economy. To put that in perspective, it's higher than Greece or Italy, and these aren't war-torn countries. Japan's debt is only manageable because interest rates are basically zero. The government pays almost nothing in interest. But here's the danger. If rates go up even a little, the math gets scary. 1% interest, $100 billion in extra payments. 2% interest, another $100 billion, 3% interest, $300 billion a year just in interest. That's more than Japan's defense, healthcare, or education budgets. There's no way to pay that without either defaulting or printing even more money. And printing money? That creates even more inflation, forcing rates higher, a death spiral. And it's not just theoretical. Markets are already sensing trouble. Japanese government bond yields have jumped from 0% to 0.8% in 6 months. That might sound small, but for a country that has pinned rates at zero for decades, it's seismic. Investors in Japan, banks, insurance companies, pension funds, they're watching these rising yields and asking, why buy U.S. Treasuries at 4% if I can get safer Japanese bonds at 0.8%? Why invest in U.S. stocks if Japanese stocks are cheaper and the yen is strengthening? Money is starting to come home to Japan, slowly, quietly. But even this small shift can hit U.S. markets hard. Why? Because Japan is the largest foreign holder of U.S. debt, about $1.2 trillion in Treasury bonds. For 30 years, Japan has recycled trade surpluses into U.S. debt, keeping U.S. interest rates low. Now that dynamic is reversing. Japanese investors are reducing exposure, selling bonds, and bringing money back home. When the largest buyer becomes a seller, U.S. borrowing costs rise. Mortgages, loans, corporate debt all become more expensive. The cheap credit fueling the U.S. economy starts drying up, and it gets worse, much worse. The yen carry trade borrowing yen at near-zero rates, converting to dollars, and investing in higher-yield assets like U.S. stocks, real estate, crypto, and emerging market debt has been a hidden engine of global liquidity for 15 years. It's what keeps risky markets alive. But if Japanese rates rise and the yen strengthens, the carry trade stops working. Borrowers lose money on currency moves, get margin calls, and are forced to sell everything: stocks, crypto, real estate, bonds. And when this happens all at once, it creates a cascade of selling, a spiral that pushes prices down fast. Think flash crashes and margin call chaos. The early warning signs are already here. The Nikkei is down 8% in the last month. Japanese banks are losing on foreign currency positions. Credit spreads on yen-denominated debt are widening. Yen volatility is spiking. These are the tremors before the earthquake. And the epicenter is February 9th, when the Bank of Japan announces its decision. February 9th is the date that could change everything. The Bank of Japan will either hold rates or raise them, and each choice has huge consequences. Let's break it down. Scenario 1. BOJ holds rates. If the BOJ keeps rates at zero and continues buying bonds, the yen weakens. The carry trade gets a lifeline. Risky assets like stocks, crypto, and real estate rally. But there's a catch. Inflation in Japan doesn't disappear, prices keep rising, and pressure builds for an even bigger rate hike later. This is just kicking the can down the road, and the market will eventually see through it. The short-term rally won't last. Scenario 2. BOJ raises rates slightly, 0.25%. This is the middle path. The BOJ signals it will normalize rates gradually, depending on data. Initial selling may happen as the carry trade starts unwinding. Then the market stabilizes once traders realize the BOJ won't crash the system immediately. This likely leads to weeks of volatility, choppy markets with no clear trend, as investors try to figure out how fast Japan will raise rates and how much the carry trade will unwind. Scenario 3. BOJ raises rates aggressively, 0.5% or more. This is the nuclear option. The BOJ signals it's serious about fighting inflation, willing to risk short-term pain. The yen surges, the carry trade collapses, margin calls hit everywhere, forced selling triggers crashes in stocks, crypto, real estate, and bonds. Global markets could face a 2008-style financial crisis. While this scenario is less likely, it cannot be ignored. The Japanese Prime Minister, Takaichi, is a reformer. She may decide the only way to restore Japan is to end easy money all at once, regardless of the global fallout. Now that you know the possible scenarios, the question becomes, how do you prepare? Here are the critical steps. Reduce risk now. If you're heavily invested in U.S. stocks, especially tech or leveraged positions, take some profits and raise cash before February 9th. If the BOJ goes nuclear, you won't have time to sell. Diversify. Don't put all your money in one asset class. Mix stocks, bonds, crypto, real estate, and precious metals. Diversification is survival in a volatile market. Watch the yen closely. A strengthening yen signals a potential rate hike and carry trade unwind. A weakening yen signals continued accommodation and temporary upside for risk assets. Consider Japanese assets. If the BOJ normalizes policy, Japanese stocks and bonds could offer better returns than U.S. markets, especially with a stronger yen. Hold precious metals, gold and silver remain safe bets. Regardless of the BOJ's move, money printing and currency debasement continue, which benefits hard assets. February 9th isn't just a routine policy meeting. It's the moment when Japan decides the future of the global financial system. Stocks, bonds, crypto, real estate, and your portfolio are all on the line. Let's tie it all together. February 9th is not just a date on a calendar, it is a turning point for the global economy. What the Bank of Japan decides will ripple across every market, every asset, and every portfolio. Here's the reality. If the BOJ holds rates, risky assets may rally briefly, but inflation problems grow, and the market will eventually correct. If the BOJ raises rates gradually, markets will see volatility as investors adjust, but it's manageable. If the BOJ raises rates aggressively, the carry trade collapses, U.S. stocks crash, crypto tanks, and global financial markets could face a 2008-style crisis. Japan controls the foundation of global liquidity, not the Fed, not the ECB, the BOJ. They control the carry trade, the flow of money, and the cheap credit that has fueled the global economy for 15 years. So how do you protect yourself? Here's your action plan. Reduce your risk. Take some profits from heavily invested positions, especially tech or leveraged trades. Raise cash before the BOJ decision hits. Diversify your holdings. Spread your investments across stocks, bonds, crypto, real estate, commodities, and precious metals. Don't rely on one market. Watch the yen as a signal. A strengthening yen signals tightening and potential risk. A weakening yen signals temporary opportunity in risk assets. Consider Japanese investments. If rates rise and the yen strengthens, Japanese stocks and bonds could offer better returns than U.S. markets. Hold precious metals. Gold and silver protect against currency debasement, inflation, and systemic risk, regardless of the BOJ's decision. The bottom line, February 9th is the day the world may change. The Bank of Japan will either continue a 30-year experiment with easy money or end it. They will decide whether inflation or deflation comes first, whether the carry trade survives, and whether global markets stay stable or crash. The countdown is on. The clock is ticking. Your wealth, your portfolio, and your financial future depend on how prepared you are. Watch this date. Position for this date, because what happens in Tokyo will shape the global economy and your money like nothing else before.